Welcome back to the plenary session. We're going to talk about the EU state aid. Some people live on this topic and some people already got up to the brink on this topic. What we try to achieve in this plenary session is what does the situation look like now the first dust has settled on these cases. What is the is it a game changer or not? That's basically the question, and how does that feed also into the whole dialogue we had on transparency, and particularly if you would accumulate the CBCR, you would add the DAX 6 mandatory reporting by intermediates and corporates on non-BAPS compliant structures, and you would add the central database that governments in Europe created for APAs. So you close an APA and it goes into a database and all the tax inspectors around Europe know about it. Then I think it's a huge accumulation of information, which I'm sure also feeds into a big filter into some of the departments in Brussels. So time for reflection on the first EU state aid cases. If we go to the next slide, and Gunnar is here as a specialist from a German perspective, but also a European perspective, adding his valuable comments. So what is the basis of the state aid? Well, how are they able to challenge certain national tax law provisions as anti-competitive? That's the big question a lot of people in the tax arena had. We found out that even if the national law doesn't have a definition of arm's length, like what we saw in the Irish case on Apple, for example, how can the OECD come up with an arm's length principle that is relevant for the case at hand? And overall, what is the interaction between the state aid, the EU ATAD, anti-tax avoidance directive, and the OECD BAPS reports? How does that all fit together? Because it gets into a very cumulative way of being attacked by governments any way they can. If we take the next slide. So state aid, it's the cumulative criteria. You need to get in a interaction with an EU member state an economic advantage, which is granted by that member state. It's selective, so you're one of the few who is been given this benefit, and there must be at least a potential for distortion of competition, and it needs to be has to have an effect on, or a potential effect on, the trade with other member states. That's sort of the game we're looking at. And by the way, the Department of Competition is at the EU level the ones dealing with this. So it's not the Department of Taxation at Brussels who is actually looking after the appropriate. So I think we've gone through this slide. So next slide. And next slide. Yeah. So this is a difficult wording. The shape of state benefits consists of a dispensation from the disadvantage of taxation. That's a very ugly wording, but it basically says you have a disadvantage because you're paying tax, but you're relieved from that by the state for whatever reason. So for tax laws measured to be classified as state aid, the advantage should be clear, and the advantage should be granted in a selective manner. So there's a couple of steps you need to be taking and as the European Commission applies them as well. What is an ordinary or normal tax system for taxpayers? How are the beneficiaries, like Apple or Starbucks or Fiat, treated differently than the normal tax system? And is there a justification is there a difference in treatment that is justified by the nature of the system? Those are sort of the whole set of criteria or 3 steps approach you need to go through. Gunnar, is there already something you want to add here?
I think the one point to really note is that with the Commission competition department in charge, they are far less sympathetic for tax authorities than the tax department. And you can see that there are always a bit of rivalries going on between the different departments within the Commission, which means that the line they drive is somewhat not the same that the tax policy drivers may actually want to pursue. But that's pretty much all up to now.
Okay, thanks. Next slide, please. So the EU, in an attempt to clarify this broadened scope of what is called Article 107 of the Treaty on the Function of the European Union, they published a further clarification. They say tax rulings, because that's the agreement between a taxpayer and an EU member state, which deal with these selective advantages. They seem to be misapplying the national tax law and result in a lower tax amount. They are not available to undertakings in a similar legal and factual situation. So basically there's some benefit you get, but your neighbor doesn't get, although similar legal and factual situations are also at stake with your neighbor. And the tax administrations applies this more favorable compared to other taxpayers in similar factual situations. So if, for example, a transfer pricing arrangement is not at arm's length because of the methodology is different from what you would apply in a normal situation. So let me give you an example. If in the Starbucks case, you're not giving a compensation based on the accumulation of transactions of Starbucks Holland paying a license to operate under the name of Starbucks and is buying coffee from a Swiss entity and selling it to various franchisees, but instead you're applying a TNMM. So you're basically saying, well, you know, you're a roasting company, but I do compensate you on a cost plus base. That is putting tension on what the European Commission considers to be a deviation from the normal way to compensate, in this case, the Starbucks Netherlands. I won't go into too much detail because that is sort of addressed in breakout room 1 in more detail. Or whether if you use an alternative method, an alternative method could be that you say, I'm going to give a fixed margin to a principal structure in the Netherlands, although the positions running through the books in the Netherlands show a lot of volatility. So then there's an alternative measurement. You know that the principal role the Netherlands plays in that buying goods and selling goods could lead to very high profits and very big losses at the same time, because this principle is riding the full cycle. However, if your ruling says you always get compensated an operating margin of 5, then there could be a discrepancy in how you get compensated from an economics perspective versus how you agreed with the tax authorities on a framed margin approach, which is deviating from the true economics. Okay, if we move to the next slide. So one of the biggest challenges is what is a normal tax system in a member state. So, for example, there's the Fiat case where the European Commission said, although there might not be, I'm not sure, is it the Fiat or the Amazon case, one of both, we don't know for sure whether there is a law in Luxembourg which says the arm's length principle applies to local taxpayers already, but we assume that a normal tax system would have a normal reference to an arm's length principle. And as a consequence, we have to assume that fractions of the law in Luxembourg do place a reference to the arm's length principle. So through the back door, we introduce a standard against which we can put the facts at hand and see whether there's a deviation. So if you say a normal tax system introduces the arm's length principle, although the national law doesn't tell you so, what does that mean? In a normal state of law, you would say, okay, there's no standard defined in law, so how can you measure against the standard which is not even embodied in the local tax law or regulations? Any thoughts on that, Gunnar?
Well, not a lot really. It just goes to show that this is kind of a very harsh concept to live with for taxpayers, because on top of the probably well-defined and case law supported domestic rules you need to apply, you also need to put this into a rather general context and try to find a justification in normal transfer pricing rules, which are much more flexible and therefore much less likely for you to be able to predict upfront what result may come out. And therefore, it's surely a bit of a burden for any taxpayer who's mostly looking for certainty and not just for a good tax saving.
Thank you. That was certainly the observation we came up with as well. So if we move to the next slide. Gunnar, you want to take this one?
Yes, of course. And another point that actually closely deals with the issues of certainty that taxpayers are so eagerly looking for. The EU state aid has a rather long limitation period of 10 years. So this is a lot longer than most EU countries at least have in terms of normal periods of limitation. And even the well-known lengthy German tax audits tend to be over far faster than that. So you probably have looking at 5-6 open years, but after that you usually have closure, you think, but you don't really have full closure as a taxpayer, because you still face a threat and a challenge from state aid aspects to your transfer pricing policy predominantly. And that is something that we've seen is quite an impediment, and it really is something that's very difficult to handle in transaction schemes and other things, because you say, look, we know we have a cutoff date then, and we know that everything before then is now time barred, and then you somehow figure out, well, there may be another backdoor where the revenue will be forced to recollect monies that you deemed were long clear and safe. So if you look at what Apple's facing, how many years back this is going to go, that is something that surely is beyond what you would usually have imagined happening.
Thanks, Gunnar. Yeah, I think the lack of a local standard in the local legislation being surpassed by the European Commission, this limitation, statute of limitation being 10 years and instead of 5 or 7 years is obviously both add to the uncertainty of closing your books and closing deals, as Gunnar rightfully says. So we move to the next slide. So this is a little bit the political nature of the arguments. What I already indicated, the accumulation of measures, CBCR, European-wide filing of APAs, maybe redefining a European-wide arm's length principle feeds into the number of EU state aid cases. A big question here would be, does the Department of Competition have enough expertise and enough capacity to deal with this these multiple reportings on EU state aid? And as we know, that Mrs. Vestager has been announcing, even on the Apple case, to take the next step of what's really their, how seriously are they politically, also is reflected always in my mind with how much resources do you put to the table to actually deal with this enormous pile of EU state aid cases. Any thoughts on that, Gunnar?
Yes, that is indeed an interesting observation. It is a political argument, ever more so. I think in essence, the Commission only started it because it's not getting any further at the harmful tax practices level, and started to look at other means of trying to confront situations they felt were not appropriate. But at the same time, you see that, for example, legislators are using the state aid argument to sort of introduce legislation that they think may be facing tough times in Parliament. So to just give you a quick example, we've just had a week ago the Judicial Service of the German Parliament issue a verdict on how they felt that not adopting a certain law that prolongs statutes of limitation for confiscation in tax law fraud cases would be an unlawful state aid, with a specific individual case in mind. And to see that happening is quite impressive, because something that started as an EU measure is now being used as a very tough argument in our domestic political haggles and situations. At the same time, you see that the state aid department within the competition department of the EU is not probably adequately staffed for the task they would have to face if national legislators are indeed, as some have started to do, increasingly forwarding laws and legislations to the Commission for approval as state aid, something that drives back to the time when I think France had sought approval and obtained approval for its IP special tax regime, which was long before the Commission started attacking IP boxes. And when they started attacking them, they found that, oh, well, they had permitted it to France, which made it a bit of a harsh general situation. And then only a political compromise at the time started between England and Germany, who agreed on a pre-runner to the current nexus approach, allowed them to further pursue this issue at all. So it is, as you see, a rather heavily moving target, driven a lot by politics, and in politics, probably not even driven by the treasury departments of any country, but rather by NGOs and their view of what a fair share of tax is. So I think there's a lot that people are facing in this context.
Do we know like digital service tax propositions like what the French were proposing and I think the Italians have introduced? Would those go through the European Commission for state aid check as well, or would they be seen as a fair reflection of this NGO pressure? I'm throwing out a curveball here to myself, but is there any thoughts on that?
Actually, I think the French are not so forthcoming forward in every law to the Commission. Some smaller countries have started doing that. So I think they will have the guts to say this is a general rule of law that applies to everyone and in the same manner. So we don't see that it is a state aid case. We don't need to notify, and then they just leave the Commission out of the loop, I would suppose. I think France is driving its own agenda there more than anything, and Italy is following suit. The French have some support from NGOs in this, but for them it's always been one of their main pressure points to say, look, we don't think this is appropriate. We feel that some countries are taking an unfair level of the tax share, and I think the French don't have that much to lose because, in fact, the French stock market isn't as strong as other countries. And for them, it's probably a good sign to show that they're chasing corporates, which is what their electorate wants them to do. But I don't think they would probably need to run this and probably want to run this by the Commission at all, because it's more of a domestic appeasement that they are trying to obtain.
Okay. Yeah.
If I may add something, Hans here. Just joined you. Apologies for not being able to join earlier. A digital service tax is in principle not a state aid, since there should be a beneficiary. It could be state aid if a comparable company would be excluded in France, for example, and therefore if there is a possibility to challenge this tax, it's the other way around. It could be discriminatory tax. But I think that France is not obliged to put that law to the European Commission, because it's not that all laws should go to the European Commission. The directive says something like laws which could include a selective element and therefore beneficial to a certain part of the company should go to the European Commission for consulting.
Okay, yeah, but my thinking was if you pay 3% on revenue and that relieves you from paying corporate income tax, and others who are not in the digital space do not get that same treatment, and maybe the 3% looks very disadvantageous because you pay it on the top line, yet the wide margins do give you a big benefit if your profitability is 20% of operating margin or higher, then obviously paying 3% on the top line rather than paying 25% on the 20% does give you a benefit. And I'm more thinking from that angle. If you get the digital service tax access, then suddenly you're in with making 20%, you're in a much more disadvantaged position simply because you don't run a digital business.
In that situation, knowing how the European Commission is looking at these cases, there might be an issue. Actually, I have here a book. This is from a lady who's going to defend her PhD next week at my university. I'm not a supervisor, but I will be in the committee which can challenge her position. She starts working with competition. She starts working in the state aid department. And if I follow her argumentation on what EU law should do, then in your specific case, since the arm's length principle is nonsense, and therefore Apple should be taxable in France, and they don't tax Apple but to 3%, then it could be state aid. So
Yeah, it sounds far-fetched, but if you do the numbers on cases if you say my target group of similar companies is anyone who makes 20% or higher operating margin, and then you say since some of them are digital, they get a beneficial treatment. They can pay off their corporate tax duty by paying 3% on the top line, which they probably wouldn't mind getting that beneficial treatment in a selective manner. So, okay, that sort of brings us to the third bullet point here, and Hans and me have been discussing this. In the old days, you had treaties and you had national law, and you still had US who was taking whatever is the newest legislation has a prevailing impact and therefore a higher ranking. Now we're looking at state aid, we're looking at ATAT measures, we're looking at assumingly proper application and implementation of MLIs, where I think a recent academic study presented at the IFA conference this week was indicating that most proper application and implementation of MLI has been happening by developed countries most of the time. So the real question here is, isn't it time for some clarity on ranking in terms of what application comes first? It's a little bit what Gunnar said. You think you had a defendable position. You file a tax return in Germany, you go all the way even to the courts, and then you're talking to your client, and the client says, well, is this really it? Are we really done now on this particular year and this final assessment and negotiated and even going through the local courts? And then Gunnar says, yeah, but there's still the 10 years of state aid because Brussels has filed a case on you. And I think it's a little bit of a question to both Hans and Gunnar or anyone else who has a view on that. Is there a need for traffic lights? So in terms of ranking, what are we really looking at in terms of application of all these tools used by governments?
Well, one thing I can say, just a quick side remark on this. The risk in Germany that you manage to get through tax courts in less than 10 years is nil. So totally fine that this will never, ever happen. But all puns aside, even if you just go through audit and cut a deal at the end of a tax audit, to know that this is not a safe outcome is something that you should bear in mind at all times, and think that this is really not in line with the way you would usually want to have such an agreement concluded. So if you knew upfront that there's still some sort of clawback mechanism in it for the other side, so to say, you would probably not want to give in on one point and succeed on another, knowing that that other point might still be taken away if the EU deems it to be state aid a couple of years later.
So that means an increase in open positions, and the more transparent you are, the more positions the other side could potentially take upon you, and they could put your the EU state aid tool at you, the ATAP tool, and the MLI discrepancy where one country signed up for the new PE definition and the other didn't. So you get quite a entangled in, rather than the dust has settled on EU state aid, that this is more like, well, how do you get cut through the chase here, and in many ways that it's very much a challenging environment we're looking at, I think.
It could get worse in our country, Steef, since we know a principle of which is called horizontal monitoring, which means that in the domestic level, companies have meetings with tax administration every 3 months. The bigger companies, the bigger they are, the more they have these meetings. Sometimes the tax administration is almost continuously present in the office of the company. And the idea is that whenever you discuss all the things you do tax-wise, that you agree on this one and that you won't have a tax audit anymore. But in the tax administration, some frustration arose in the Netherlands where this concept, which is an excellent concept, has been also used for smaller companies as a measure to save costs and need less tax inspectors. And therefore it's being used on a separate level. And these inspectors who were angry have anonymously informed the press, and the press has written about this and has posted all this information to the European Commission. And the competition department of the European Commission is still researching whether the horizontal monitoring system could be selective, since there can be a company elsewhere in the Netherlands where something has given which creates a beneficial advantage for that company that could be state aid. Well, the good thing is that in the Belgium case on state aid about their ruling, the advanced, what's called the excess profit ruling in Belgium, where the European Commission lost the case. They lost the case because they challenged the ruling and they didn't challenge one company and the benefit that company created. And here, horizontal monitoring, the difficulty for the European Commission is that they have to challenge all companies individually for all the benefits they would have created, and that's impossible. And that's happily the reason why we haven't been challenged yet. But also what I read in the PhD, I'm reading for my PhD student, not for mine, but for my colleague's PhD student, the European Commission goes, beyond their limits, I think.
But Hans, let me try to understand that. So you're saying horizontal monitoring in Holland allows corporates to cut deals with tax inspectors, sometimes as part of a compromise on cases. And then if the European Commission would come in and analyze one specific corporate or one specific industry, your feeling is that that horizontal monitoring, which is really like an X-ray, a real-time X-ray putting on corporates, but there's always going to be some give and take type of settlements on certain deals to the left and to the right, then that what you're telling me that the EU Commission could come in, ask the file from the Dutch government on horizontal monitoring of company X, and then select the cases which they felt there was this selective benefit being granted. So it's working, although the Dutch government is promoting it, it works not necessarily in your favor if the European Commission would ask for your file.
Yes. And when they started the research, after they received the information from the journalists, the excess profit case in Belgium hasn't been decided yet. So they still thought that they could challenge horizontal monitoring in such a way that either the Dutch government would give inside information on all the files. It's impossible, but there are too many. Or that the Dutch government would stop with the horizontal monitoring system. But after they lost the case against Belgium, they could indeed still step in at any company, because they're part state aids from the competition department, and they have the right to step in with any company and to demand information which they need to do their work. That could indeed happen. I don't see it happening yet, but it could happen. And 2 years ago, before the Belgium case, I would have expected that it should happen. But now I'm a little bit more positive. It could happen.
But Hans, if you do horizontal monitoring and within that, on a monthly basis, quarterly basis, you cut 5 deals, sometimes in your benefit, sometimes not. Isn't that a new style of rulings which automatically need to be displayed into the APA ruling database by the European Union, or is there a smart move by the Dutch Ministry of Finance which gets them away from that?
any situation where you agree with the tax inspector not to put anything on paper is already a ruling according to European law.
That's my point. So the feed of the information to the European Commission is like almost like a black hole sucking in all that information, also including all the what you didn't agree on, what to not put it on paper type of deals. Even that would be sucked into this black hole going to the European Commission.
And you can see how complicated this is, because this would create many rulings per company anytime you give and take anything. So.
But we're now actually drifting off into a lawyer's talk, really, because let's be practical about it. The main rulings that the Commission attacks are those that are in writing and in paper. And if you say, let's not put anything in writing, I don't think that any tax inspector would then go home and put in writing that he has not put something in writing. First of all, for general nature of tax inspectors not wanting to have extra work. And secondary, of course, because it defies the purpose of what they are doing. That said, though, if you find out, or if you really want to shoot down something like horizontal monitoring, and you take a political view on this, and start to just investigate a handful of larger corporates where there may probably be more at stake in horizontal monitoring, and just start attacking these individually for prohibited state aid, and ask the Netherlands to reclaim these funds, they will lose their face, and therefore their ability to continuously go on with horizontal monitoring if they have an issue with their largest taxpayers in doing so. So I think there still is a risk, depending on how much of a will there is to shoot it down. And that's the horrid thing about it. It's relatively arbitrary at what point in time which system gets picked up. I think in the first round, what the Commission has attacked in state aid were predominantly cases that if you take a deep breath in some distance, you understand why they may be hard to understand and defend for somebody who's not very deeply rooted in our system of transfer pricing. So ocean income, for example, is a concept that I think I understand why it looks alien to somebody. If you look at other things which are day-to-day doing, I think it's much more difficult to predict that somebody's going to willingly attack these, but it still can happen. So there's, if say one NGO jumps at the gun and everybody follows suit, then it's a matter of weeks before the Commission starts doing something.
You have to take into account that in the Netherlands, horizontal monitoring is in principle not intended to give any benefits. It's intended in difficult situations to give like an ATR on the spot, which is an interpretation of law. And that's, I think, which saves the Netherlands to a certain extent. But I said, 2 years ago, I said it should happen. It's going to happen that the Commission steps in. But now I think it could happen, because you and I know that, Gunnar, that in those kind of situations, here and there, you give and take, as Steef mentions it. And if you give something, and then the take is probably state aid. But that's also the difficulty, because what is the benefit?
It's true. The point starts coming in if you, and the Netherlands probably is not at that high a risk because you don't have that much of a state-owned or partially state-owned industry as we would have. But if you look, for example, a case that in Germany we're currently discussing, is that probably the revenue didn't pursue apparent tax fraud at its Landesbanken, just in order to make sure that they are still sufficiently funded not to go bankrupt. Obviously, nobody's ever going to admit that this was the motive, but it's somewhat easy to understand. And if you say, well, we just didn't have the resources to pursue that group of criminals, but we did it with others, it becomes state aid quite clearly. And if you cut beneficial deals in horizontal monitoring with, I don't know, the Dutch railway to make sure that you can support them, then probably you get to the point where this might become an issue.
Yeah.
Yeah, it will be after COVID-19 will be very interesting, because state aid is all around us. But we have KLM, by the way, Gunnar. So you have an airliner which has a similar support by your government, I believe. So you know, there's plenty of cases at the horizon. I think we're running towards the end. Raymond had one important point to make. The deals you can, although Switzerland is not strictly EU, if you deal with cantons who are more or less acting as agents on behalf of the federal governments, but could take different positions, then how do you deal with that two-ranked system if you get benefits at one level and the higher authority at federal level can step in, but only on the federal portion? So that's sort of an interesting ranked system in terms of, is a deal you close with cantonal, which could be much more beneficial also if Switzerland would be state aid. Would be a EU member state. Is that not undermining the whole relationship between the EU and Switzerland, where everyone in the EU tries to put Switzerland on a level playing field from a tax perspective as well? So different arena, worth at least 3 hours of talk, but we're running out of time. So I suggest
one last remark.
Yeah, go ahead.
And then I really stop. EU has a bilateral agreement on cooperation with Switzerland, and the EU has told Switzerland they will cancel that agreement if they wouldn't agree that the state aid principles are applicable also in relation to Switzerland.
That was my point. Yeah. Very good. For the breakout, maybe the next slide, I think